You're watching the program that identifies market trends, provides insightful analysis, and reliable research. Key elements to help you profit from the pros. Profit from the Pros is brought to you by Zacks Investment Research. Learn more by visiting them online at zacks.com. Welcome to Profit from the Pros. I'm Terry Ruffalo. Well, a huge, well-received General Motors IPO, some upbeat U.S. economic news, and a possible aid package for Ireland all had investors' attention this week. Economic data that investors had to digest included a report that retail sales rose 1.2% last month. A less-than-expected climb of wholesale prices in October was offset by a slight drop in core prices and just a slight increase in the overall consumer price index for October. Those stories, along with news that the four-year average of new jobless claims hit a two-year low, all helped to support the market through the week. A congressional oversight panel, meantime, said banks should undergo another round of stress tests due to legal challenges to foreclosures. And Caterpillar announced a large acquisition, which we'll talk more about a little bit later on in Stock Talk. Let's bring our editor-at-large, Steve Reitmeister, back in here now. Steve, you've been keeping a real watchful eye on the Dow's current tussle with 11,000. Main drivers here, or can you point to just one main driver?
Right. The main drivers for the market is always about what's going on with the economy and what that means for corporate earnings. The thing is, right now that looks very good. But as we look forward, which is what investors are trying to do, do we stay on that modest growth path, which would be fine for the stock market, or do we succumb to some of the problems that are lurking out there? Do we succumb to the Eurozone sovereign debt issues, and will that keep rolling over to different countries and wash to our shores? Mm-hmm. Is quantitative easing round two a good thing or a bad thing? I mean, certainly experts in our field are debating that right and left, and people think it have very diverse outcomes. Yep. So this is why we are tussling with Dow 11,000, because on the one hand things look terrific, on the one thing things look terrible. Yeah. Okay, and which will be the true outcome?
All right. What about the bank stress test developments? You're a little bit concerned about that?
I am. I was surprised the market didn't react much to that when it was first announced, and even the bank stocks didn't really react much to that. So I guess what they're saying, the way it was sold was, hey, no problems here, folks. We're just going to check things out. Everything's fine, and it's just always healthy to do a little stress test now and then. Right. I'm not so sure about that. I mean, where did all the bad debt go? And if maybe I'm mistaken, but it sure looks like there's a lot of foreclosures out there, right. And so all those syndicated loans, they still have a lot of foreclosures in them, and they're not paying off as they should be. So I'm going to be very interested to see how this plays out.
Right. Maybe it disappeared like all the oil did after the spill, right?
Let's bring our options expert in here now, Kevin Matris. Kevin, you say investors should not discount using options as part of their investing strategy. Give us some weekend wisdom then on why options are good to consider.
Well, it's interesting because more and more investors are using options nowadays in their trading to be able to beat the market. And really, it's not hard to see why. Options are flexible. You don't need a lot of money to get started, and really it's a lot easier to do than you think. First one is flexibility. You can make money if the market goes up. You can make money if the market goes down. You can make money if the market goes sideways. Mm-hmm. And in some strategies, you can even be wrong on the direction of the stock and still make money in the option. Now, again, that doesn't mean that you can just blindly, pick stocks and you're going to start making money, but it is interesting because it does show that you can make money in any kind of market environment. The other benefit is that you can get started with a very small amount of money. You can actually get into an option for a fraction of the cost that it would typically take you to invest in the stock itself. And many strategies will give you a guaranteed limited risk. Now again, there are differences between stocks and options, but this is just one of the reasons why, if you start looking at them, you may realize that this is a very smart choice for your own portfolio. But what's really interesting is that in spite of all of the popularity, options aren't really that understood as stocks, and I really think they should be because they are easy and very, very practical.
Give me one key option strategy that might be considered.
Well, here, I'll give you the easiest one in the world. You talk about if you're bullish on a stock, you can buy a call option. I would say the best way to trade that would be to focus in on momentum stocks or aggressive growth stocks. Those are the ones that have probably the most explosive upside potential, and that will be a key component for the success of your options trading.
All right. And Steve, coming back to you here, I just want to circle back. You said, you wrote recently in a commentary that investors need to be nimble now in their strategies. What does that mean exactly?
Right. Well, like I was saying before, which outcome is going to be the case? If you try and be 100% bullish and things aren't so wonderful, then you're going to get blown up. If you're 100% bearish and things actually stay on that modest growth path, then you're not going to do so well in that strategy either. So the idea is to pick one side or the other, but don't go 100% bullish. Maybe go 60, 70% bullish and keep some stuff back, or have some things that are defensive in nature in case things blow up, like shorting the bank stocks, which I am doing.
And options play into any scenario here in the nimbleness approach?
You know, I'm not as much of an options guy as Kevin is.
Kevin, quickly?
I'll tell you real quick. I mean, you can do a straddle. If you can make money if it goes up or down in a big way, that's a great option strategy.
All right, we'll see you both a little bit later on. Stay with us. More still ahead. Here is your Bull and Bear Stock of the Week. A toy company and a shoe company make up this week's Bull and Bear of the Week. Kind of an interesting mix there. We're going to find out more details on each one of them now with equity strategist Bill Wilton, who makes a guest appearance in this spot here to talk about the Bull and Bear of the Week. Thanks for coming on in, Bill.
No problem.
Zacks Pacific, JAKK, the ticker symbol, I almost got lost on that one there, is the toy company. Kind of an interesting toy company because they look for merchandising opportunities that have television tie-ins primarily.
Yeah, you know, a lot of the names that you see out there, Star Wars, UFC, Pokemon, a lot of different popular names, you know, they're the ones that are making these toys, action figures, playing cards, that kind of a situation. Yep. And you know, it's a very hot industry, especially for them right now. They've been expanding, you know, just to diversify their product line, which speaks volumes for their financial health. They've got a lot of cash on the balance sheet, able to go ahead and make those deals that makes them even bigger and stronger than, you know, they were heading into the recession. So that's definitely something you want to see. Their earnings estimates are looking fantastic. Analysts are looking for them to grow about 43% this year.
Wow.
So there's definitely a lot of room for growth and optimism in Zacks Pacific right now.
And it's supposed to be a good holiday shopping season, hopefully for toys as well.
Yeah, they've got a lot of momentum going in there. We also recently saw a better than expected you know, retail number, so that also bodes well for them.
Right.
You know, if consumers are more likely to be spending, they're going to do that on the holidays. They also are getting some momentum from their Halloween sales because they make costumes and things like that, which are expected to be you know, better than we thought initially.
Did I read correctly that they are or have restructured or will be restructuring?
Yeah, they're in the process, and what it's done is it's really lowered a lot of their costs and their overhead, which is obviously something that you know, you want to keep to a minimum, and that's usually the trend that you see coming out of a recession, is that the companies that do survive are running leaner and meaner. They've, you know, like I said, they've got a lot of cash on their balance sheet. Their expenses are low. They're really ready to pounce on any opportunity that's out there.
All right, Skechers USA, SKX, ticker symbol. That's the shoe company. That's the Bear of the Week for the second week running, I might add. Tell us why this is so bearish of a stock.
Well, one thing, you know, I wanted to bring up the other side of a retailer. You know, just because retailers are doing well does not mean you can just pick any retailer out there.
Good point.
One thing that is particularly bearish about Skechers, you know, they had been a phenomenal growth story. Everyone, you know, was in love with their growth rates, but once you see a slight pullback in those or some uncertainty going forward, those are the ones that typically get hit the hardest. So this is, you know, has the potential to be a very, very bearish stock. As far as uncertainty in the future goes, with Skechers, what I particularly don't like is that they don't really have a long-term deals set up with any manufacturers, you know, and that's
for their product.
Exactly. That's one of the worst things that you can have going into a stock is uncertainty in the future. After all, we're a forward-looking market here, so if we're not sure what's out there, that gives investors every reason to, you know, go ahead and avoid that stock. If people own it, they're probably going to be taking profits because it has done well recently. So, you know, there's plenty to be bearish on Skechers here.
So long term is where the negativity comes in, primarily
Yeah,
on
and
this
once you can't see, a reasonable amount into the future, that is when people start getting skittish and don't want to be a part of that stock anymore.
Got it. Thanks for joining us. We are talking about another stock yet. Stay with us. And now, Stock Talk, analysis of stocks in the news. Well, Caterpillar said this week it will acquire Bucyrus International in a deal worth $8.6 billion. Yes, that's B billion. Equity strategists Tracy Reinick and Mike Vodicka are back with us to take a closer look at CAT. And this is really, the biggest in Caterpillar's history.
Yeah.
Right?
Yeah, it's definitely a big deal for them.
Yeah, it expands their whole leadership in that mining equipment sector.
That's right. It's actually a great deal for them because there's almost no overlap in the two companies, which is kind of hard to believe, but true. And so they're going to basically stop up the places where they didn't have as much exposure, and Bucyrus obviously is getting the other areas where they didn't get exposure, and so they're going to be this big dominant global mining and big machinery company that will dominate the world.
Yeah. Okay. Calm down, Tracy. Mike, there's some interesting technicals on Caterpillar stock here over the past 18 months.
Yeah, there are. We saw shares of Caterpillar take a pretty big plunge during the financial crisis of 2008, 2009. Shares traded to just about $20. But since then, over the last 18 months or so, we've seen a pretty incredible rebound with shares jumping back up to $83. And then as it stands, we're only $4 away from the all-time high, which is just a pinch above $87. So they've got some really nice short-term momentum right now.
But it's really, it spanned a decent price range over the past 18 months, as well as hitting a high and a low.
That's right.
Like
yeah.
Multi-level highs, multi-level lows.
It is kind of unusual to see this kind of movement in a share price like this, but that's kind of consistent with what we've seen over the last 18 months where the market rallied really strongly out of the recession, and this has been one of the leaders out of it. And also an interesting thing to point out too, just a testament to the strength of Caterpillar right now, is when the deal was announced for Bucyrus that you mentioned before, their share price actually went up on that. And usually when you see an inquirer, their share price will take a little bit of a hit, but the market liked it so much that we saw a little bit of a short-term bounce. So that was interesting too.
Yeah. So I'm reading here that Caterpillar hit a 52-week high and a 52-week low, all in that 18-month period. Is that like unheard of for a stock?
I wouldn't say it's unheard of, but like I said, for a company like Caterpillar, they do have a lot of resilience because it's not easy for Johnny-come-lately to come into this industry and set up a company like Caterpillar. So we saw those high barriers of entrance play out in the share price over the last 18 months.
So going forward, overall, would you say the technicals are bullish?
Absolutely. The technicals are strong right now. In spite of the fact that we've seen these big gains right now, we have some short-term momentum, and the stochastic, which is a technical indicator pointing out whether shares are overbought or oversold. The stochastic says shares are actually trading fairly close to oversold territory, so that would indicate short-term strength.
So Tracy, this deal is supposed to close about the middle of next year. According to projections from the company, it includes a combination of cash from the balance sheet, debt, and about $2 billion in equity. That's kind of interesting as well.
It is, but their main business is commodities, and commodities are booming, and they're having huge growth in both Asia and Brazil right now. So, going forward, this kind of deal is going to pay for itself. They see it being accretive already into earnings next year. And, they're going to see double-digit earnings growth even before this deal. So things look good for them going into next year.
Caterpillar estimates the deal will save them about $400 million in annual cost beginning in 2015. That's also pretty good for shareholders.
Yep.
All right. Well, we thank you both for taking a closer look with us at Caterpillar this week, and want you to stay with us because the Roundtable is next here on Profit from the Pros. Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. Ireland, inflation, and the overall U.S. economic picture, along with top stock picks of the week. You'd want to stay tuned for that. That's what's on tap here at this week's Roundtable with our editor-at-large, Steve Reitmeister, research director Shiraz Mian, and market technician Kevin Matris. We're going to start with Ireland. Steve, I'm going to start with you. You've heard the news that came out this week on Ireland, as we all have.
Something happened?
Unless, of course, you haven't.
Okay. Yes, I have.
How bad do things have to get there
Right.
How much room is left at the bad end of the
Right.
spectrum?
The European Union has plenty of money to take care of Ireland. It's what's next that bothers me.
Okay.
So Greece is no big deal, Ireland's no big deal, and then Portugal's going to come. And then maybe Italy, and then who knows? Okay, so what I'm saying is it keeps kind of rolling up the hill, and they're not going to have money for everyone if this keeps rolling around the bend. So Ireland's not the issue, it's what comes next that bothers me.
Okay. And any possible scenarios about what comes next?
Well, that's what I'm saying is, Portugal, which is another small one, and so they're going to say, oh, Portugal, that's easy enough to take care of. Here's 10, 20 billion, boop, fun.
I mean, I thought you were going to be like Mr. Rubini, who actually enumerated which ones are going to come next this week.
Well, then get him on the show if you want that. But what I'm saying is that we all knew those were the ones that were in trouble.
Yeah.
Okay. But what I'm saying is that if you get someone larger, like a Spain, okay, which is probably the next one, or in Italy, now we're getting a little bit larger on the scale. They don't have enough money for everybody. That's all I'm saying, and those are problems that would wash to our shores, I think, in time.
All right, and Shiraz, when exactly might we need to be concerned about when it washes to our shores?
Surprisingly, I'm not really much worried about the European debt crisis now. I think what the Europeans did in response to the Greek scenario is enough of a boundary wall around the problem to contain it, not just from us and the rest of the world, but even their own economies. Greece had some serious problems. Ireland, more on the banking side, not so much on the government side. They have problems. The Europeans will get in. They will recapitalize their banks, as we did over here through TARP in the U.S. Steve mentioned Italy and some of the others. Spain has been in the eye of the storm for a while now, and their banking sector has surprisingly been extremely resilient. They had a housing issue, but the extent of the losses and the loan loss portfolio over there is far less than we saw over here in the U.S. So my sense is that the problem is fairly contained. It's restricted now to the Irish banks.
Okay.
The Irish government had made, in my view, a very bad decision earlier on when they guaranteed all banking liabilities, and that's basically coming back to haunt them with the Europeans standing behind them. The Irish, and then even later on the Portuguese, should be in good shape. So I don't think these are coming to our shores.
Okay.
Deja vu all over again,
All
right?
right. I know that you regard this as almost pretty much a contained event as well.
For right now.
Okay. Any new business? Oh, no, that's my job. We learned this week that inflation is at the lowest level here in the good old U.S. since 1957. However, it's raising concerns among some circles about deflation. Right. Kevin, does deflation concern you?
Clearly, it concerns the Fed. The Fed has an inflationary target of 1.7%. We are well below there. And one of the main reasons for them implementing QE2 was to be able to create some kind of inflation. And all these inflation numbers are bearing that out, that their concern was very real. Although I do believe that we will see the economy pick up. I think there will be inflation. We have to worry what we wish for, because eventually this is going to be something that we're going to have to deal with. But right now we want to stimulate inflation. But I would say I think the economy is very healthy. We got the Philadelphia Fed survey just a couple of days ago, and that was a spectacular report. Things skyrocketed, and I think this is the biggest thing that bodes well for the economy. Orders were up. Shipments were up, hirings were up, and I believe that also supports the idea that you're finally going to see new jobless claims go down. So I think this could usher in a whole new wave of new growth.
All right, Steve, the University of Michigan economists this week said that nation's recovery is going to remain sluggish through next year, won't really start to pop until 2012. What do you think about that?
Okay. A lot of diverse opinions in the economist community. I think the IMF recently lowered their outlook for the United States in 2011 as well. I think they came in like 2.2% was their expectation. Previously, they were in the high twos. But then they say that a rebound to 3% GDP growth or greater in 2012. I think that kind of fits in with my outlook. So if people take a look, then they think that's terrible, but really that's muddled through. That's working through the problems that we have. But 2% GDP growth is better than 0, is better than -2, which is where we would have been if we didn't put in a lot of the stimulus and other things that we had. So I think it's fine to work things out that way, and I wouldn't be surprised if we do come out in 2012 and beyond with a little better growth. Yes.
All right, Shiraz, top stock pick of the week.
I have basically a play on the weak labor market. It's a staffing firm, Manpower, and it's a global staffing firm. About 10-15% of its revenue comes from the U.S. Everything else is global. They're very exposed to about half of the revenue comes from the industrial sector, and then the clerical, the temp jobs and the permanent job creations is picking up, and I think Manpower gives you good leverage to that.
All right, Kevin.
Biogen. They are a biopharma company. They focus on R&D, commercialization of different kinds of drug therapies. Their main focus is in cancer-related treatments, autoimmune problems, and this kind of thing. They've got a solid rating. If you take a look at their earnings estimate revisions, they are going up across the board. They have one of the best projected growth rates of everybody in their industry. And if you look at a stock, they just broke out of a nice big consolidation pattern because they reported earnings spectacular. I think there's a lot of good things.
All right, Steve.
Holiday is right around the corner.
Yep.
I'm going with Stephen Madden. When retail analysts take a look at what's going on out there, they like the shoe category. Stephen Madden right in the thick of that. And they like the accessories as well. Stephen Madden right in the thick of that. It's been growing quite well for a while. More to come, and brilliant balance sheet.
All right, thank you all for being here. Thank you for being with us as well. Hope the week ahead is a profitable one for you. We'll see you next time.